Before we get into today's video, some regulatory compliance. My name is Andrew Alexander. I am Head of Investments for Three Counties, an independent financial advisor based in County Durham, England. This video is for anyone who has an interest in investing and investment markets, both retail clients with no experience of investing through to industry professionals who invest for themselves and their clients. As independent financial advisors and wealth managers, there is no commercial relationship between ourselves and today's guest. The purpose of this video is educational, and in no way should any of the content be construed as advice, nor is it an enticement to invest. Past performance is not a guide to future performance, nor a reliable indicator of future results or performance. The value of investments may go down as well as up and is not guaranteed. Therefore, investors may not get back the amount originally invested. And now, onto the video. Welcome everyone to another of our weekly investment manager videos, and many thanks once again for tuning in. The UK market had a great end to 2021, outperforming most developed markets, if not all. And 2022 has started in the same vein. However, is this the start of a UK equity renaissance, or will UK equities once again unfortunately flatter to deceive? Well, to answer these questions and to give an outline on how he is viewing the market, I'm delighted to once again bring to the channel David Ridland, manager of the Castlebay UK Equity Fund, and once again the last fund manager in Glasgow. Last of a dying breed. But first, before we get into the content, if you're enjoying our channel, it would be wonderful if you could subscribe if you haven't already. It really does assist us in delivering our weekly financial planning and investment content to YouTube as a whole. So after all that begging out of the way, once again, onto the content. And David, many thanks once again for joining me. The UK market, as I said, has had a good end to 2021. Why was that?
Do you know what? I think this whole period, Andrew, we're kind of, it's really instructive to look at it from 2020 and just
Yeah.
before, COVID struck, obviously. And, we had a drawdown, generally better quality businesses that were more resilient. I mean, resilience was the watchword.
Yeah.
Had less of a draw. They were still sold off, but had less of a drawdown. What was fascinating about 2020, not last year, 2 years ago now, was the fact that normally once you've had the bottom of the market, the nadir, the low quality, higher beta type, more exposed to the market, those types of stocks normally rally the strongest. But for the first time, certainly in my career, I mean, I can think back to the Asian crisis, the TMT, the global financial crisis. For the first time, that didn't happen, and the quality businesses rallied very strongly. So, as you know, that's the sort of area in which we focus. And so it meant that our fund had a positive return then, but towards the end of 2020, when there was obviously the beginnings of the rollouts of the vaccines, etc., there was a bit of light at the end of that tunnel of COVID. You saw, a bit of a rotation, and you saw a rotation into the sort of deeper value part of the market, or certainly let's say the cheaper valuation end, in a lot of businesses that had been struggling for many years, actually, in terms of certainly their share prices. And so you saw a bit of a rotation into that value, which bled on into 2021. And then that kind of rally ran out of a bit of steam towards the end of last year. And our kind of fund, the quality was out of fashion a bit in that time period. Again, we're talking short time periods. Certainly, as we invest on a kind of 10-year plus basis. We're investing in businesses, not share prices. But just to give you the kind of arc of that story, and then that continued into the end of the year. Maybe we've had a bit of a rotation back again. I think the banks, for one, have done very well. As you know, that's not an area that we have any exposure to, because we just don't think the returns profile, is high enough for that sector, and there's obviously a lot of financial risk involved as well. So that's kind of a brief recap as to why everything has flowed the way it has. But to come on to what you're asking about the UK market, I mean, clearly over the last, it must be 5 or 6 years now, it's certainly been in the doldrums. You've had obviously Brexit, all the other kind of issues, and so the UK market has, in relation to say the US, been very, very cheap and attractive. And so, is this going to be the year when we see that rotation? Who knows? It could be. And I think the other aspect, when you look certainly in relation to the US market, that's had quite a narrow leadership. You know, the FANGs, the technology businesses have driven up and have become so large.
Yeah.
It really is the main driver of the performance. And I think back in 2020, when the US market had a positive return, if you'd stripped out those tech businesses, they would have had a negative return, like the UK market as well. So in all this, it's really interesting to kind of separate out the market, these components within it, and then we obviously look at it through our lens of investing in quality businesses and trying not to overpay for that privilege.
Yeah. Do you feel that this like kind of leadership in the UK or you know ex US, do you think that can be sustained into this year and through 22?
Yeah, so I mean that's a fascinating question. I think the key thing we everyone is talking about now is obviously inflation.
Yeah.
Because when the world economies were stopped in 2020, obviously the kind of tap was turned off, had massive impact on demand, and then you've got a recovery, and then obviously the central agencies, you know, the Fed in the US, and obviously the Bank of England and obviously the Treasury in the UK, are trying to keep on this stimulating taps, if you like,
Yeah.
to get things recovered, and that often means you get the rise in inflation. And what we've been trying to separate out is how much is temporary and how much is more permanent. And frankly, the Bank of England is still wrestling with that. And so the mindset that we've got when we look at that, and to try and answer your question, is should we be trying to base our investment process and philosophy around calling these inflection points, whether it's inflation? I started off in the Japanese market in the lost decade of the 90s. So there you were talking about deflation.
Yeah.
And in many ways, that's even more injurious to your returns because people just delay their spending. If I can get it cheaper next week, I'll wait and delay my spending. Here, I think it's much more about inflation. But again, businesses that are doing something different, the types of businesses that we really like, they have the kind of magic pricing power that we talk about. So when their cost base are rising because of inflation, it gives them somewhere to go. They can increase their prices. They're doing something that their consumers, clients, customers demand and really want. So a bit more of an increase in price doesn't lead to a big fall off in volumes. And so that means they can hold on to their margins and returns. So that rise in inflation is often accompanied, obviously, by rising interest rates, because the Bank of England will be looking and saying, we don't want overheating, so we'll put interest rates up. But again, Andrew, here's something that makes this time a bit different. I mean, they can be dangerous words in investment. This time it's different. But what we are seeing is it's likely that interest rates will stay below inflation. And people often talk about that in terms of financial repression, because you're letting inflation, go on a higher path, and that can obviously impact people's real wealth.
Yes.
And the sort of day-to-day cost of living obviously will likely continue to increase. And so in all that equation, we think we are well placed owning businesses that are resilient and have optionality. These high quality companies that are doing something different, and they can respond to these changing prices that we're seeing.
Yeah. Focusing on that and your own, viewpoint, focus, specialism in quality companies with a value approach as well, it must be stressed, but the big focus upon quality. Do you believe that against this backdrop of I don't know whether it's a new paradigm or not, but against this backdrop of raising inflation, raising interest rates, fiscal tightening, do you feel like your approach can outperform this year, bring benefit to clients' portfolios? I think is probably the key element as well in terms of diversification. And then also, have you made any recent changes to the fund, taking all that into consideration?
So on the first point, Andrew, talking over this year, we don't know. Is the honest answer? It's in our kind of investment horizon. It's a very short time period, but I think what is clear is, and if the past is any guide, and obviously disclaimers abound in terms of the future being different from the past, but because of that pricing power element I was talking about and the resilient business models that we've seen, gives them just generally more levers to pull, and that's helped drive real returns and helped keep things above. As you know, we look at CPI plus 4%, which is quite unusual for UK equity fund manager, a long-only fund manager. But the reason we do that is because we know, as fellow investors in the fund, our other investors and we are wanting to protect and grow the real wealth of our investments, and we think that's the best way of doing it. And what it does beautifully in our minds is it frees us up to only invest in these businesses that fit this quality and value criteria. So coming back to the point I was making earlier with the not owning banks, because they don't fit into that, we don't own them, and we readily accept, as you've seen in the very short time period over the last few months, with that potential rising interest rates, the banks can come back into favor because it's called they call it riding the yield curve, where they can borrow cheaply in the short term and lend out to people and make that positive return over a longer term period. We're entirely comfortable with that.
Yeah.
But coming back to what you're saying in terms of getting that balance between quality and value, we have actually been just at the very back end of the year. Our turnover was again very low. I mean, that's an output. It's never a target, but it's just an output of, as I say, investing in these businesses.
Yeah.
But we did recognize there were a few companies whose valuations were getting to a level where this retained return equity, this compounding quality aspect that we see delivering the largest part of returns over time, was beginning to get outweighed by that valuation getting slightly expensive. That's the way that we actually combine that quality value approach when we're allocating money in the fund. Yeah. So we sold out of Kone, the Finnish lift maker, one of our obviously European companies. In its entirety, we had reduced exposure again because the valuation had become a bit extended, and we also reduced Novo Nordisk as well, which had a very, very strong run. We still owned some of that, but we took the funds from both of those sales and invested in a US business called AutoZone, which is the leading auto parts retailer in the US, and it's got a fantastic business. It's a bit like, there's William Thorndike wrote a brilliant book that focused on about 7 or 8 CEOs, including Warren Buffett, who had been excellent capital allocators. And our view, we're just about to write our quarterly investment letter, so you've this is a sneak preview before it hits the printing press. But we talk about this in there. We're saying, had the book been written 10 years later, AutoZone would have been a real candidate to go in, because 20 years ago they had 149 million shares in issue. Now they've got just over 20 million. So through a series of share buybacks, the management team is focused on buying back their shares at attractive valuations, because it's considered quite a boring industry. So it's never highly rated, it's never overvalued. It's quite conservatively valued. So they just kept buying back these cheap shares on offer by the market, and expanded because it's a highly cash generative business. And so we took a position in that. So that was one thing that we did, again from the kind of valuation perspective. And then the other aspect was we bought Next, PLC, which we think again is going to be, or is one of the winners in a changing retail environment.
Absolutely.
And that whole story is about, people talk a lot these days about omni channel retailers. So it's it's online, it's physical presence, it's click and collect, it's different ways for the convenience of the consumer, obviously. And they've got a really interesting strategy that Simon Wilson, Lord Wilson, has put in place over many years now. He's been in charge not pretty much 2 decades, but responded really well to just this changing nature. And I mentioned earlier about resilience and optionality. With this business, we think there's a really good optionality that they've got here, because they have their own retail offering, the Next brand, but they've also got hundreds of what's called label. It's on the label brand of other retailers that pay a commission to use their their website to sell through, and another one called Total Platform as well. And so the analogy we often use, Andrew, is that in the gold rush, it's the people selling the spades that make the money. So in a changing retail environment, Next could be the people selling the spades, because they're not just selling their own products, they're selling others. And the winners of those third-party retailers will emerge, and Next will benefit.
Yeah, absolutely. I couldn't agree more. My wife certainly couldn't agree more. Let me tell you.
Yeah,
And my interaction with that stock is taking the returns back to the store, and it's
that's
so
it.
easy to do that. You know,
That's it.
you'll walk in with a bundle of returns, and they just take them off you, and you go, "There you go, fantastic, brilliant,
Well,
thanks."
I mean, that is a really good example, Andrew, because that's how
Yeah,
they've managed to pivot. They've kind of run down the investment in the stores, reinvested in the online offering,
yeah,
but nearly half of the returns still go through the stores, and it's just convenient.
it is.
So
It's that
it's a
convenient.
way of turning an historic millstone, because obviously, see Debenhams, see, a whole lot
Yeah,
of retailers that have had big estates, and as things have gone online increasingly, and the cost structures have changed, they've been left high and dry. But again, Next have managed to pivot and turn a challenge into an opportunity.
yeah, absolutely. And I think finally, just the how I look at it as someone who creates portfolios and talks to guys like you and globally, you've got to really look at the valuation at this moment in time. We are moving into a new environment, an environment that a lot of people haven't really worked within, to be perfectly honest. Where we've got inflation that is obviously here. There's no doubt about it. We've got rising interest rates. We've got fiscal tightening. QT is now a word where it just used to be QE. So this is
Yeah,
going to be interesting. And so valuation does count, and maybe people have benefited massively from the previous allocations over the last 10 years into highly valued global stocks, and it's done well, no doubt about it. But we are moving into a new environment, and looking at both valuation, but looking at the pricing power, and what you said there is absolutely crucial in the face of rising inflation. The ability to protect those revenues, to pass the costs over to the consumer, and the consumer being happy to pay for that, is absolutely crucial. So people looking to allocate away from the US, that tends to be the incumbent at this moment in time, to the UK, are looking for value, looking for pricing power, looking for quality. They'd be hard pressed to find something better than what you are offering in an environment. Let's be perfectly honest, of a lot of the same different type of stuff, a lot of the same process. So anyway, I'll be interested keeping a watch over 22, and obviously communicating with you guys to see how you perform. I've no doubt you'll be absolutely great. But there's a nice bit of positivity at the end of a video, isn't it? Anyway, David, it's been absolutely magic catching up with you again. You stay safe, and I'm sure we'll catch up soon.
have a great 2022.